Hey guys, welcome to the show. Pretty pumped today. We're going to be talking about private equity. Private equity is an asset class that very few in Canada actually own or are able to own, but we can do it here. And I have with me today none other than Daniel Cohen. Daniel Cohen is a director with Fiera Comox Partners, and they specialize in private equity. They've been doing this for a very long time, very successfully. I'm thrilled to have him here. Daniel, thank you for being here.
Thank you for having me.
All right, let's talk about private equity. So first off, describe to me the asset class as a whole, because most people think equity, they think ownership in companies, and they would typically buy those on a stock exchange, on the NASDAQ, on the TSX, or publicly traded companies. But when we're talking private equity, start with the bare basics. Dumb it down for me.
Yeah, so it's the exact same concept as what you would think if you overlay, public equities where you're owning a stake in a business. So I guess if we take a step back at its core, private equity is just acquiring and holding for a fixed period capital investments in private companies. Now, private equity firms like Fiera Comox, we add value for our investors, whether it's retail or institutional, by supporting the growth of these businesses that we invest in and improving the operational efficiency of these businesses, which is unlike what you would be able to do if you were a public equities investor.
Yeah, you can't buy shares of Home Depot and say, I'm going to remove management and I'm going to improve their processes. I'm going to give them better point of sale service. You just can't do it, right?
That's right.
But in your space, you're actually, so what percentage of companies are you guys buying?
It really depends on the situation. So our mandate, unlike what you might see in the market, we have a very agile and flexible mandate. So we can invest and take a minority stake or a significant minority stake all the way up to being the controlling shareholder. And that'll depend on the circumstances surrounding the deal and the underlying company that we're investing in. So in our portfolio today, we actually have a mix of businesses, single name businesses that we own, where we own anywhere from 5% all the way up to 90%.
How many names would you have in that portfolio?
So if we take a step back, there are a few different ways to access private equity. So traditionally, private equity investors would access the asset class through what's called a closed-end fund. So a closed-end fund is where basically you'll have anywhere from, call it 8 to 13 or 14 direct deals in a portfolio. And the private equity portfolio manager will go and deploy capital over a few years and then harvest and grow those businesses before they ultimately exit. And traditionally, we see closed-end funds that would have a term or a fund life of anywhere from 10 to 12 years.
Yeah, and as they sell, as they exit, you get a distribution, you get a return of capital or whatever. You sell 2-3 businesses in 7 years, you get a bit of a check, and then in 10, 11, 12, they wind it down.
That's right. Now, the issue with those closed-end funds, they've worked obviously for decades. However, there are some issues, and one of them is the fact that for those first 3 years while the fund is fundraising, people who commit to the fund are actually being charged fees on their commitment, not on invested capital, which effectively results in a negative return environment for those 1, 2, or 3 years. Now, that's called the J curve. Yeah. And so if you're evaluating closed-end funds, you'll traditionally see the first few years, the returns are actually grayed out or not shown because they're traditionally negative. And then once the fund starts to deploy capital into deals, it starts to generate a return for its investors, and then you have a hockey stick effect. The other issue is with closed-end funds, when you're committing to the fund, you're basing it on the fund manager's track record and effectively their promise to you as to what they're going to do with their fundraised capital. And so there's this concept of a blind pool where basically you don't know what's in the portfolio because the portfolio is fresh and the fund is just launched. And so you're basically putting your conviction in what the manager is going to do once they launch the fund and have raised capital. Now, what we've done is we've created an open-ended fund. And so this is what, Rob, you have access to along with your clients. An open-ended fund actually mitigates those two quote unquote problems or issues with closed-end funds, such that there's actually no J curve, because at this stage in our fund's life cycle, we're with the Canoe fund that we've launched through retail 1.5 years into the fund's life cycle, but it's open-ended. And so we're constantly fundraising and constantly deploying. And so any investors that have come into the fund, basically they're getting access immediately to the existing underlying portfolio. They're also able to see as of that moment, what is in the portfolio, and then they'll get access to obviously what's to come as well. And so in one fell swoop through our open-ended structure, you're actually mitigating the J curve and you don't have blind pull risk. Now, that's a long-winded answer of getting to your question, which is how many investments do we have? And so today, our fund is sitting at 21 investments, and we're continuing to look at new deal flow to add to our portfolio. So it's really a living, breathing fund, not one that is capped at, call it 10 deals, which we're going to harvest over a 10 to 12 year period.
Yeah. And private equity, I mean, I'm a big believer in private equity because I believe that true diversification exists only when you can actually reduce your volatility, have uncorrelated assets, and provide exposure to an asset class that's not just publicly traded stocks. So someone might say, yeah, but Rob, what's the difference if I own equity, if I own it publicly or privately, right? And I would say, well, if you care about your volatility in your portfolio, historically, private equity is a lot more stable. Also, private equities typically trades at a lower multiple. Therefore, when you're buying it, you pay less for companies, and maybe you'll tell me I'm wrong. And also on the exits with value add that you guys are doing, you can actually enhance returns. So you could do better returns with less volatility and truly diversify the portfolio. That's why I like it. I like it because returns, less volatility. So that gives you a better risk-adjusted return. And you're actually getting true diversification for the client. So we were adding private equity to clients' portfolios, like I'm talking years and years and years ago, like decades ago, back when the only way you could do it was through close end. And it was very, very difficult. You had to take very, very large positions in the Canadian retail space. It was tough. It was tough for me as a portfolio manager to get exposure for my clients, Mr. and Mrs. Retiree, for them to get, 5% of their portfolio in private equity or 2% or 3%. It was almost impossible. So I'm glad that you guys are here. Dan, I know this because, I've been a supporter of you guys for a while. So the funds have done remarkably well. This year, in a year where the S&P and the Dow are getting hammered, you guys are up, I think, 5 or 6% or something, and, generating positive returns. And the actual masterclass fund, which is kind of a longer track record has been doing double digits, I believe, for a while. So I think performance has been really remarkable given what we've seen, and you've met all the expectations. I think your clients are extremely pleased. So how do you think you get that? How do you go about getting that? What's the value add? How do you guys differentiate yourself from the other funds, and how are you generating those returns?
Yeah. So look, I mean, I can't comment as to whether we're doing it better than the others. I mean, our returns have met expectations in what's been a very choppy period. If you look at public market volatility and what's happening from a macroeconomic perspective globally, I think the things that are working to our advantage. So obviously the fact that we have an open-ended structure, it allows us to be patient and pick the right spots to deploy into. By nature of our DNA, we are a conservative bunch, and because the senior leaders of our firm come from the pension plan world, where they were the heads of some of the biggest Canadian pension plan private equity funds. Our DNA is to focus on downside protected absolute returns. And so how do we do that? Well, for one, we're diversified both globally and across sectors. So we seek to invest both in North America with a focus on obviously the US, just based on its relative size to Canada, and then also in Europe, UK, and in other developed countries. And that's
so of the 21, how many are American?
So today we're sitting around 80% US, with the
and
balance
then the other global, international.
Europe. Well, it's primarily Europe, UK, because we actually own two businesses in Europe, UK. So that's where the concentration of our portfolio is today from a direct investing perspective.
Okay. And what about like the actual underlying sectors that you have? Is it mostly like tech? Is it like what are some of the examples of the companies that you guys are doing?
Yeah, so look, that's been our other saving grace, and what's contributed to the return profile that we've been able to achieve in these choppy markets. So as I mentioned, we're focused on downside protection. What does that mean? Well, we focus on resilient industries, so business services, financial services, healthcare services, industrials, manufacturing. We basically look for sectors that are resilient, regardless of what's happening with the global macroeconomic environment. And then we're looking for resilient companies within those industries. So cash flow positive, non-venture like businesses, they really have to have an EBITDA or profit cash flow return profile We like to say $10 million of EBITDA or more a year.
Okay.
So we're really looking at more mature businesses.
Okay, a mature business, 10 million of EBITDA. So what are you paying for that business? What's the multiple? And for those that watching at home, typically these deals are always traded on a multiple. So, a publicly traded company might be an average, long-term average of 15 to 20 times earnings, maybe even more if you're in the tech space or in the growth space, quite a bit more for some companies. Where do you guys find yourselves buying these companies at?
Yeah, it's a good question. So what I will say, just for background, and you touched on it, what we have found is historically the delta or the arbitrage between what you pay for a public company versus a private company is anywhere from 1 to 2 turns of EBITDA. So you're paying a discount of 1 to 2 turns for a private business. Now, if we look at our portfolio today and we overlay that against the S&P, for example, what we have found is our average EBITDA multiple today is sitting at around 9 times. Whereas, if we compare that to comparables in the S&P, it's at over 12.5 times. So if you think about that from an arbitrage perspective, you're getting an arbitrage with our portfolio that is larger than the traditional historical arbitrage between a public company and a private company.
Yeah, but Daniel, if that's what the companies are trading at, how do you actually capitalize on that arbitrage? You have to go public?
No. So the businesses where we're positioned is in the middle market, the global middle market. So it's rare that we're going to invest in a business that is big enough or will be big enough to be taken public. The typical exit scenario for us is to trade either to a strategic, so a larger player within the same space or in an adjacent space, or to trade to a different or another private equity firm, whether it's a private equity firm of a similar size to ours or a bigger private equity firm.
Right. So you're taking it to the next level.
That's right. So, there's a few different ways we create value. One is obviously by buying the business for less than it's worth today. So having some form of multiple arbitrage right out of the gate. The other is by creating value. So we create value in a few different ways, or can create value in a few different ways. And so if you parlay those two things together and then you exit to the right player, you end up with a positive return for your investors.
So one deal might be you buy something at 8 times and you build it up enough, you talk to some competitors and they end up buying it at 12 or 13 times. Another one might be that you buy it at 9 times and a larger VC fund buys it at 10 times or something like that. And you just make the arb on that. Plus you've made kind of the income or the EBITDA while you had it. And that like, how long would that cycle take? Is it a 1, 2, 5 year cycle?
Yeah, so we actually would not sell to a VC fund. It would be traditionally would be another private equity fund.
Okay, sorry.
Because we actually, based on our mandate and our risk appetite, we do not make any venture capital investments. And that's part of the reason why our returns have been what they have been during these choppy markets where tech companies have gotten hurt. So in terms of the life cycle, again, this goes back to our open-ended structure. We have the luxury of really holding on to an asset for as long as we believe it's delivering greater returns to our investors than by selling it. And so whether that's 3 years, 4 years, 5 years, 8 years, we have a long-term view towards our investment strategy. And so we're happy to hold on to an asset. And every business we buy, we believe our quality long-term holds. But if something does exceptionally well and someone wants to pay a significant return for our investors earlier than expected, obviously we would entertain it.
Yeah, you're kind of agnostic to the duration, right? Like you don't really care because it's in a fund or a wrap or a pool of capital. If something exits, you would just buy something else. So you're almost agnostic, right, to whether or not you sell it. You want to make sure you're creating that shareholder value for clients at all times.
That's right.
So how big is the master fund, or how many dollars are you guys managing in total there in the private equity side?
So the Fiera Comox global private equity strategy, we have an AUM that's over 600 million Canadian.
Okay, and that I imagine that's growing, right? Because alternatives are becoming more and more front and center, right?
Yeah, that's right.
Okay, so these investments. So you guys talk to me a little bit about the due diligence that goes into one of these deals. If you're doing 21, how many a year do you do? And What are you doing? Like 2 or 3 a year, something like that?
Well, it depends on fundraising, because obviously we're trying to give investors, retail investors in particular, a great experience. And so part of that is making sure that you deploy relatively quickly. Obviously, we're not going to deploy just to deploy, but still, to the extent that we can get investors deployed quickly, it's a nice attribute. So I look, I mean, it's really dependent on the year, the types of deals we're looking at. Last year we did, 8 or 9 deals. This year we've done 6 or 7. So again, that just happens to coincide with great fundraising efforts through our partners like yourself. And whether we do 4, 5, 6 a year going forward, and we just potentially write bigger checks, it to be determined. We don't have a fixed number of deals that we're looking to do a year. It's more to marry deal flow with fundraising. And in terms of adding value, look, I mean, so we touched on multiples, buying businesses for the right price. We've touched on, value creation levers. So whether it's, helping the portfolio company with M&A, refinancing or helping them, create the best debt environment for that business. Whether it's operational hires, which we've done with some of our portfolio companies where we help, go into our network and secure certain key hires for the business. But really what it comes down to is when we do due diligence on these companies, we have a tremendous information advantage because in private equity, you're able to do a lot of heavy lifting before you invest in the business. You're able to speak to customers and suppliers. You're able to interview management and do background checks and reference calls, all the types of things that you really wouldn't have access to as a public equities investor. You have an information advantage in private equity because you have access to all these different due diligence streams. So we leverage, the internal team to handle the bulk of the work. And then obviously we work with external partners, whether it's law firms, accounting firms, consulting firms to help supplement the work that we do.
So what do you think Canadians should have in their portfolio in terms of private equity as a whole allocation?
Yeah, it's a tough question to answer. What I will say is we've noticed that U.S. endowments and Canadian pension plans, which are traditionally considered to be gold standard investors, particularly in private alts and private equity, they have increased on an average basis their allocation to private equity, pure private equity, like what we do at Fiera Comox, from 8% in 2008 to 23% in 2021, and that figure continues to grow. Now, we can't tell you or your clients that they should have 25% allocated to private equity, but we certainly don't think that it should be 0, which is the case for many Canadians or
almost every Canadian's at 0%. I see a lot of statements on a day-to-day basis from people that tell me, Rob, what do you think of my investments? Right? They go to www.speaktorob.com. They book a no obligation consultation with me to chat about their investment portfolio. I show up on the Zoom meeting and lo and behold, they have the RBC Balance Fund or they have some large bank institution's balance fund. And like they have 0% private equity. I'm trying to think, like, is it 1 out of 100 or 1 out of 50 that I see that actually have a little bit of private equity? It's extremely rare. So you're right. We are trailing. When I did my MBA 15 years ago, I looked at these endowment funds and why they were outperforming Canadians, retail Canadians. That's what I studied. And I saw largely they're outperforming because of asset allocation. Not because they're picking MasterCard or instead of Visa or they're better stock pickers. It's largely because they have better asset allocation, private real estate, private infrastructure, private equity, farmland, asset allocation that Canadians don't have that I'm trying. And that's what built this business. I'm trying to build this business basically, and I am building this business to bring retail endowment fund asset management, which has been proven to be much better than anything Canadian retailers can do to Canadians. And it's been working. It's been working tremendously. 2022 has been a great year for us. Why? Well, because we had very little fixed income and we had, very little traditional public equity. We had a lot of alternatives. So I'm glad to hear you say that you don't believe it's 0. I agree. Obviously, you're preaching to the choir. I'm here interviewing you about it. So I think it's something that needs to change in the Canadian retail space. I'm doing the best I can to make it change. Could there ever be a situation where you would take that fund and just IPO it, the entire fund? Could that happen?
So I don't think that could happen. I mean, what you see occasionally are other private alternative managers where the general partner or the fund manager will IPO. There's some bulge bracket firms out there that have done that. I'm not sure if that's in the cards for us. I mean, we're still what we like to consider to be, in the ramp up phase of our business, and we're just happy to be partnering with folks like yourselves in the Canadian retail market, and that's our focus.
Right. So the focus is private equity, continues to be private equity, global private equity. You've done it with very little. Talk to me about how the portfolio is valued on a month-to-month, quarterly, or annual basis. Like you have 21 companies. You must produce a NAV, a net asset value per share basis every month?
That's right.
So how is that number picked? How is that number created?
So our investment team we conduct a NAV estimate valuation once a month. So we strike a monthly NAV estimate, which then our partners at Canoe would use to produce their NAV, which is what yourself and your clients would see printed once a month. Now, effectively, what we do is on an intra-quarter basis, so month to month, we're looking for what we consider to be material deviations for each of our assets. So whether it's what's happening in the public markets, whether it's something that might have materially impacted a direct investment positively or negatively from a sales perspective, EBITDA perspective, M&A. So that's what we'll look for on a month-to-month basis to adjust the NAV. Now, on a quarterly basis, we do a deep dive into every single asset and strike a quarterly NAV. And on an annual basis, we have an audit and a third-party external valuation conducted on the portfolio. So there's a lot of oversight from a governance and valuation perspective on what we do vis-a-vis valuation.
If you're seeing the public, sector for one of your investments trade dramatically negative because of some macro global event, you're going to write down that business a little bit in your portfolio. If you're seeing some of your peers jump up in valuation in a certain space, you might jump up, increase the valuation of that specific business in that sector. And then annually, you're asking third parties to validate that information.
I'd say holistically, that's right. However, I guess just to add to that, we are a conservative group in nature. It's from the way we invest to the way we value. So as an example, when the markets were red hot last year, we were relatively conservative marking up our portfolio. And so by the same token, when the markets go down, we have to apply the same level of conservatism. But in general, that's right. If obviously a sector that we are invested in, is negatively or positively impacted in the public markets, we'll have to incorporate that into our valuation in some way, shape, or form.
How many negative months this year?
As far as I can recall, there have been 2 negative months this year.
Yeah. That's what I like. It's stable. It's stable because it's you're not increasing the multiples to 50 when it's going great, and you're not dropping it to 5 when it's not going great. I love that. All right. Well, hey, I know we're running out of time here, so I do want to thank you, Daniel, director at Fiera Comox Partners. This was fantastic. Great look into private equity markets and how retail Canadians, you, Mr. and Mrs. sitting at home thinking about, do I have this in my portfolio? Should I have this in your portfolio? Your portfolio manager or your advisor probably cannot get this for you. Give us a call. Go to www.speaktorod.com. We'd love to book a no obligation consultation for you to chat about this or anything else that's on your mind. Guys, don't forget to like, subscribe, click the follow button, and make sure to give your comments below. If you're wondering about this, you'd like to comment, we'd love to hear from you. Daniel, thanks so much. Everyone else, I'll see you in the next video.
Thanks, Rob.